Okay, so it's now okay. That's good. Right. It seems like it's okay now. Let's get going. Right. Just bear with me, guys. Oh. Okay. It's fine now. Thank you. We just had a few people come around. Okay, let's just get going now and we'll see how it goes. Now, let me just grab some charts for you and then we can get going. Okay, so this was just my UK setting. Let's take a quick look at cable. I'm assuming everything's all right, guys. I don't know if FX Street or if it was loud 1 minute. I don't know what the problem was. But just turn down your machine if it's too loud. So this is cable, as you can see, hasn't really reacted. There's a couple of things I want to point out here. Let me just do a bit of a drawing and a bit of a zoom. We may have broken that downtrend yesterday, from the beginning. That basically dates back from the first week of the year, when we reached that 166 level. 166 we still think is that key medium high. Tomorrow is going to be really critical. As you can see, we're really testing this area. 166.50 to 60 is a very important level. If we get a daily close above that tomorrow, then we're in a positive position as we go into those reams of UK economic data. There could be some, sterling positive news tomorrow, based on two things. Number one, if we get a strong labour market report, and number two, the IMF is expected to revise up the UK's growth outlook for 2014. Now, whether or not you believe the IMF's growth outlook is quite strange, because this would be the second upgrade in a mere kind of 3 months. So back in October, they predicted the growth would be 1.9%. They are now looking for it to be 2.4%. So quite a significant change. As you can see here, the pound is reacting to the slightly better data. Obviously, this big candlestick that I'm circling here comes all the way from, or dates back to that retail sales report on Friday. And then since then, we've extended gains, not nearly in the same way. We're kind of more treading water, consolidating a little bit. And actually certainly in the next 24 hours anyway, we're going to see that we're going to, have a lot of fundamental drivers for the pound. Now, what does this all mean? For us, if we, there are two ways. There's a lot of data coming out tomorrow, the labour market data and also the Bank of England minutes. The situation that we think we could be in is where the Bank of England minutes end up being quite dovish, point towards the lowering of the economic threshold. But yet, on the other side, the labour market data could be quite strong. Now, it could be quite strong. I'm not saying it will be. Obviously, December has been a weaker month for some of the for certainly on the PMI front. We've seen growth come off the boil. However, if it is strong, if the labour market data continues that upward trend, remember, labour market is also a lagging indicator, so it might not lead immediately to weaker economic data might not feed into that straight away. But if we are to see two pieces of dovish data, so maybe slightly weaker than expected unemployed labour market and also dovish minutes, and we could really reject this resistance level here and get down to this 163.45-ish area, which is the 50-day moving average. If we get below there, then it's kind of the low 163 area really, which was the low before that retail sales report. And the lows from last week. So, they are very much in view. Obviously, if we get a really strong labour market report and dovish minutes, we think the labour market report will actually trump that, and we could get back above that 166.60 mark, because, it would just show that, the economy or the labour market anyway, is pointing to, better data. And even if they were to reduce the unemployment threshold to 6.5%, if the current theme continues, then we could get quite far. Then we could see, further gains in cable, sure. And we could actually see a continuing trend in the labour market data, and we'll get to 6.5%. So it's almost like, the Bank of England will end up chasing its tails. Another thing that I want to point out from a fundamental perspective, guys, I know some of you aren't that fundamental in focus. I know some of you are asking questions about the dollar, yen and Kiwi. I will answer them. Just bear with me, guys. is that the market has been very reluctant to believe and trust in the Bank of England. So that's another thing to point out. Even if the minutes are dovish, but we get a good labour market report, we think that would be the most bullish case for the bullish scenario for sterling in the next 24 hours. And as I said, it's very clear where we could go. We do think this 166 level is key. It's also the 166.30 is the 200-month moving average. We don't think we're going to get above there at all, no matter how good tomorrow's labour market data is. But we could get above just this level, comfortably above this level here, just this kind of falling mini downtrend that goes from kind of the beginning of this month. If we can get above there, then it suggests that maybe it was just a temporary decline, and we could be on our way back to these highs from the 10th of January, which come in around about that 165.25 level, and then potentially make another stab at 166. Dollar yen has also obviously been on the cards. Dollar yen's been really interesting. In fact, I want to show you a different chart. I'm going to create one for you guys. Bear your here. I'm going to show you the dollar yen and the Nikkei. I know some of you who have joined this webinar a lot will know that I've harped on about this. But I'm just harping on again because it continues to hold. So what we saw last week was some sharp declines, right, in the Nikkei. We saw some very sharp declines. And then, that dragged dollar yen lower with it. In fact, the yen was one of the best performing currencies last week against the US dollar. But since making that low, kind of sub around about that kind of low 103 area, we have bounced back, and that corresponded with a bounce back in the Nikkei. So as you can see, it's not exactly perfect, but they do tend to move in the same direction. You're not going to get much of a closer correlation than those two. So right now, if you're trading dollar yen, just keep an eye on what the Nikkei is doing. It's also worth keeping an eye on the S&P 500 as well. What tends to happen is that we see dollar yen rise, and then that corresponds with the rise in stocks. A lot of people have asked me, well, which one leads the other? At the moment it could be, there's a couple of things. You could argue that it's the yen that leads everything, and it's the currency perspective that leads things. That when risk aversion grips the markets, we see the yen rise, which causes dollar yen to fall, and then that leads to wider risk aversion, which then hits the stock market. Reading a few bits today, a lot of some of the key short-term traders out there are thinking about turning bullish on stocks again. I'll just bring just a smaller little insert chart here. Bear with me one moment. Because this is S&P 500. So as you can see, roughly moving in the same direction. Didn't have nearly as sharp a pullback, but as you can see, still moving very strong. 1850 is the level to watch in the S&P 500. That's the record high. We're only 12 points away from there already, so we could easily break into fresh record territory. And if we do, then that would be another signal. As long as this relationship holds, and I'm not guaranteeing that relationship will hold, but if the relationship between dollar yen and stocks, which has held pretty well for the last 12 months, continues to hold, then a break higher in the S&P 500 could be good news for the dollar yen. And the reason why I just say the S&P 500 there, it's kind of a global benchmark. The Nikkei and the S&P 500 are moving roughly in the same direction as well. So if the S&P goes up, there's a good chance that the Nikkei will follow, and then that could potentially drag up dollar yen as well. Now, Alan, you were talking about dollar yen. It's possible to retest 102 and a half. Indeed it is. Let me just bring up a proper dollar yen chart so we can have a quick look. Sorry guys, I'm a little tiny bit under the weather today. So as you can see, we've been really sticky. We're consolidating. But there's a couple of things I want to point out. Number one, this looks like quite a powerful level of resistance, which is that 105.70 level. We've spoken about that before. It's a key resistance level. A lot of people's minds are on it. If we don't get above that 105.70 level, then it's going to be very hard. Well, obviously, it's going to be very hard for us to get above, get to 110, which is a lot of people, which is a major target out there and a key psychological level. The other thing I want to point out to you there is the 50-day moving average. Is that what you're asking, Milan? What is SMAVG? It is a simple moving average. It's just simple moving average. A very, very quick 101 on moving averages. That's all they are. They're just daily moving averages, or based on your time frame moving averages, and they just smooth out price action. So as you can see here, just looking at this, as you can see, we had a nice uptrend, Then we kind of moved sideways for a while, didn't go anywhere. We traded in the range, and then just drifting higher again. And it just gets rid of this noise. So these big daily, intradaily drops that we see, gets rid of this noise. So, for us right now, the outlook is still bullish. The moving averages are still pointing higher. That's one bullish sign, one of many, by the way, and I wouldn't say it's necessarily the strongest. The other thing as well is that we did manage to hold above the 50-day moving average, which is key support, which comes in at 103.16. That to me just suggests we're in a bit of a holding. We're just in a triangle pattern. In fact, I'll draw it for you. We've obviously got the Bank of Japan coming up this week, so there isn't too much on the US front. Bank of Japan coming up this week, and then we have the FOMC next week. So there is a lot of fundamental risk for this pair. But if the Fed does as we expect and actually don't they look through the weak NFP data, then we think we could see a stronger dollar yen. And just look at that. Look at today's candle. We're testing that 104.7 level, which is kind of the top of that triangle, which is triangle resistance. So we've been kind of trading just really within a range, just consolidating for the last kind of month, or since the start of this month. If we can get above this 104.70 level, then it takes us back to these highs really at 105.70. And then, whether or not we get above there, we may need a fundamental driver. Does it come from maybe a surprise shock from the Bank of Japan late tomorrow, early Wednesday? Or does it come from the FOMC? One of my colleagues, we were talking yesterday, and, they were looking for a potential, they were looking for a potential, sideways move right into that FOMC meeting. I hope not. We all like, a bit more movement than that. And I certainly think in the short term anyway, if we can get above 104.70, that's the level to watch. I know, great. So Peter, you've been very helpful to Milan. That's good. I know someone was looking for Kiwi as well. That's been an interesting one. And then I'm going to talk about something really interesting, possibly the best break of the year so far. This is dollar Kiwi. What was the question? Let me just guess. What's my opinion on dollar Kiwi for the next 1 to 2 months? It's going to be really interesting because I think there's some upsides. There's a potential for upside risk in the Kiwi, actually. This is New Zealand dollar versus US dollar. As you can see, trading really within a range. We're managing to hold this key support level, 100-day moving average, 50 to 100-day moving average, which comes in between kind of 80 to 50 to 60. That's acting as very good support here, as you can see. But obviously that 84 level, we did get some selling interest. We did see a bit of a push higher last week. That 84 level really is capping gains because there's a couple of reasons for that. Firstly, there is expectation that the RBNZ will, be the first bank to hike interest rates, but we're not sure on that yet. There's a lot of risks to them doing that, and there's a lot of downside suggesting that they may choose not to do that. Bear with me, guys. I'm just going to swap charts around because I just want to show you something else. So that could, that's the fundamental reason to be long Kiwi. But right now, as I said, we hear from the RBNZ next month. We haven't really seen, we hear from them next week, about 2 hours after the Federal Reserve, so on the 31st of Jan. That's going to be a real key week. So next week is going to be absolutely massive for the New Zealand, this pair, because obviously of the proximity between the two central bank meetings. But also if you get, say, for example, a slightly more hawkish than expected statement coming out of the FOMC combined with maybe the RBNZ trying to talk down the Kiwi dollar, that could really see us slice through these support levels and maybe get to that 81.5 level, or even these lows that go back to early December, which come in around 80.80. So that's kind of, for us, Kiwi is in a range. We're trading between kind of 82 or 82.5 all the way up to 84. I didn't see in the very short term, Alan, how we could get out of that range. I think it's going to really rely on next week, and I think we're going to be in a holding pattern with investors getting very nervous around Kiwi dollar as we lead up to that double whammy of event risk next week. Okay, Manoj, you were talking about the commitment of traders report. Indeed, I'm going to show you the CFTC one on this is dollar yen, and it just why it's interesting, right? It's basically let me just show it to you first before I choke on my words. Okay. So this is Commitment Traders report from the CFTC. So they produced a report which basically acts as a little bit of, just to give you a little bit of sense of direction and sentiment in the market. It's a good market sentiment indicator. So as you can see, this is yen position in the market, been a speculative market. That's all this measures. Has been selling yen since November, December. And since the beginning of the year, they've been pushing it higher, which has corresponded to dollar yen. Let me just pull up my dollar yen chart. Up above the 170. Manoj, I do agree with you that yen positions are looking stretched. Hence, we've seen a little bit of take profit around about that 105.30 level. But I still, the market is still net short, and I think this is just a little bit of positioning, a little bit of waiting for the next direction move from the Fed. There is obviously some hesitancy to get to that 110 mark, and the market has always been a little bit hesitant to get to get comfortable above 105. And I'm sure for dollar yen bulls, the reticence to stay above 105 has been, pretty nerve wracking at times. But I still think, that the fundamental backdrop is there for a weaker yen. I think this is just some positioning, maybe some taking profit. Some people are expecting maybe to get in at a better level if we fall back. Alan, I know you mentioned that 102.5 level in dollar yen. Let's just bring that up quickly. I mentioned to you that we're looking quite constructive, 103.16, and then I think that 102.5, or just sub 102 level, are these kind of, these lows here, which come from kind of earlier December, and then it's that kind of just sub 103 really, which were the lows from the 13th, so from this time last week. CPI was good Peter, you mentioned a good point. CPI was good. From Japan. However, a lot of it is down to the stronger yen. So it's not real inflation that's coming through. And there is expectation the Bank of Japan will find it still very difficult to reach their target. I hope that kind of makes sense. For now, Manoj, I don't really think the Commitment of Traders report is going to do too much to change the dollar yen. But as we lead up to some key fundamental events, we're going to have to wait till that FOMC meeting. I certainly don't see us getting above 105.70 or breaking any fresh ground. And then Peter, I'm sure you're going to be looking quite closely at what goes on with the Bank of Japan meeting this week to see whether or not they stand ready to do anything, or if they're happy with the way CPI is going. As I said, I don't think they'll be too happy because a lot of it is just down to that stronger yen. It's not actual inflation. So that means that it may not stick because, obviously the currency can be volatile. So that's kind of one concern. Now, the other thing I wanted to show you was this. This is CAD. Look at that. Dollar CAD above 110. I'm just going to send you something as well. Just bear with me, guys. This would be my latest note on dollar CAD. It hit the bullseye, got above that 110 level. Bit of stickiness around here. There's some key areas. Oh, I'll just send you a link to it so that you can read it on our website as well. It's hit some, sticky areas. We've obviously got a lot of event risk over the next kind of 24 to 30 hours. We've got the Bank of Japan, Bank of Canada meeting tomorrow. We've also got a bit of economic data today. All that Bank of Canada stuff and the economic data today is really in stark contrast to a real lack of data in the US. So that could be something that pushes us high, or certainly be one of the key determinants or key drivers of dollar CAD could come from the Canadian fundamental side, particularly from that Bank of Canada meeting. As you'll get my view on where we could go next, why I would potentially look for 112, and how the Bank of Japan, or the Bank of Canada, getting all mixed up with my banks could potentially react. So as you can see here, 110, we're above 110. I think the high has been 110.19. That was from earlier today. But there is something I want to show you, because a lot of people have been saying to me, I really like this trend, but I feel a bit nervous getting in it at this level. Totally understand that. Where could we see maybe a bit of a resting zone? Where might we see a pullback? We think this one at 110.60 level, 61 actually, that's the top of this monthly Ichimoku cloud, as you can see here. That is significant. Now, not everybody will look at monthly Ichimoku clouds. We are aware of that. However, they can be quite good when you're at these kind of, multi-year highs trying to find a level. So what I'm saying is 110.60, I think, could potentially attract just a little bit of profit taking, a little bit of stickiness. And then if we pull back, 109.90 is, you'll see it in that report I just sent you, but basically 109.90 is the daily pivot. Then we have 109.65, which is the 21-hour moving average. That could 109.5 to 109.65, so that 21-hour moving average that I just mentioned, could attract some buying interest. Now, if we do pull back and we break through 109, let me just bring up the 1 year chart here. If we break below 109.20, pink line, tan line on chart, that would be a very negative, or that would potentially suggest that any pullback is going to be deeper than expected, but we really think that is a low chance of that. I mean, Manoj, I think what you just said about dollar CAD, yes, that it's gone through significant resistance levels, and probably the most significant of all was that 110 level. Yes, I think, does it suggest further upside? Well, it suggests that the bulls are back in control. As you can see last week, there was just a little bit more hesitancy. We think that was largely because of, some profit taking, squaring up ahead of that 110 level, and that now the markets really are kind of back in control. Obviously, this is also a little bit of positioning leading up to that Bank of Canada meeting tomorrow. That's going to be, certainly worth watching out for. The announcement will be 3:00, and then we'll get kind of Governor Pollard speaking, from then on. Do watch out for that. Whether or not we extend gains beyond that 110.60 level, I think will be very dependent on what the Bank of Canada says. Certainly in the next, as I said at the beginning, in the next 24 hours, what goes on in the CAD is going to be determined by Canadian domestic events. So certainly worth looking at there. But right now, it's a key, a lot of people have been talking about this being the trend of the year so far. You can't really fault them for that. The charts give it away. It is, nice kind of acceleration higher. And if we can maintain these gains, then we believe it could open the way to 112, which would be the highest level, since the summer of 2009, since early summer 2009. Pan, you've said, is this dependent on oil revenues, or what fundamentals do I look at for CAD? Oil is a bit of a funny one for CAD. It's not as sensitive to the oil price, largely because it's usually very sensitive to the US economic cycle. But this time we are seeing, we potentially might be seeing a bit of divergence. I mean, interestingly, no divergence for the December labour market report. Both Canada having a terrible labour market report, but the US not having a great one either. So it seems like there was something, we're looking at the domestic economic fundamentals rather than the oil revenues. Obviously, the fall in oil price isn't helping any commodity currency anywhere, and it's expected that the fall in oil price will actually continue. So, this drop in, dollar CAD for us, there's a couple of things. We've seen, a very weak PMI data for December, that very weak labour market data that really has just weighed on the CAD. Added to that, what if the US economy was to falter again, or maybe it's not as strong as expected, and the Fed is embarking on tapering? It's not necessarily good news for the CAD. So I think the CAD is being hit. I think you're right to mention oil commodity prices, but we also think that it's being hit by fears over the US economic outlook, because the US economy and Canadian dollar move very, very closely. Now, the other thing to throw in the mix there is Mexican peso. This is dollar mex, as you can see, not nearly having the same type of upswing as the dollar CAD, but it has kind of pushed higher in the last kind of couple of weeks, broke through some key resistance levels, and is now, looks like it's testing the top of its range. If we can get above 13.30, that opens the way to the highs of the last 12 months, which come in at 13.46. Obviously, the risk, Canada and Mexico have certain similarities in that they're both kind of oil producers. The other thing to point out about them is that they're both, really reliant on the US and US economic strength. So if the US economy looks in any way like it's faltering at the same time as the Fed is tapering, then you would also expect the MEX to do badly. And just as we've seen today, with dollar CAD really pushing higher, we've seen dollar MEX push higher as well. Okay, the other thing I'm going to point out is euro. Euro, we just had some data out of Germany. The ZEW, the forward-looking part of the ZEW, which most people consider the most important, was quite weak. We got below. It fell. It was weaker than expected, even though it remains at high levels. But that data disappointment certainly wasn't liked that well by the euro. The euro, as you can see, closed the week below its 100-day moving average, which comes in at 135.72, and it hasn't been able to get above there. So any pullback like we saw yesterday has been very shallow. Now, yesterday we got as low as kind of 135, but we did manage to see some buying interest there. And likewise, we've got, we're currently back above, we're above 135.30. Now, 135.25 is a key level. It's trend support. Let me just draw it. Oh, sorry, wrong one. I'm sorry, no, it's not from there. Bear with me. It's a trend support line, and it's also a Fibonacci level. So we really need to hold above there. For us to see, to make a type of comeback. Obviously, that break below the 100-day moving average is bearish, though. Whether or not we, do get below this 135.25 level and stay below there in the medium term could depend on Thursday's data. We get some important data out of the Eurozone. We get PMIs for January, so the first reading of that January data. If that's weak or disappoints in any way, that could be another fundamental reason to just push euro-dollar below here. And your next levels to come into play are this 134 level, but then even potentially 134 all the way down here, which is the 130. Where's that? 132.96, but obviously 133.54 is your key level here. That's your 200-day moving average. So, there's certainly, it looks like the bias is on the downside. We're not looking oversold as yet in euro, so there could be further downside to come. As I said, what's going to push it could potentially be Eurozone economic fundamentals, and if they don't support it, then that could leave euro in a very weak position as we lead up to next week's FOMC meeting.